Well, obviously these issues around stress and rental stress, housing stress are becoming quite dominant. As well as rental stress, homeowners could be about to get a rude shock if interest rates go up next week or even after that. It would be the first rate rise in more than a decade, and with inflation rising steeply, it could be more than the standard 25 basis points. The government and the big banks maintain that after 2 years of government supports, many households have built up their financial buffer, that they're ahead in their mortgage repayments. But will it be enough? Martin North is the principal with Digital Finance Analytics. Welcome back, Martin.
Hello.
As we know, inflation is the highest it's been in 15 years. What proportion of households are already finding it difficult to make ends meet?
Well, I measure it in terms of cash flow, money in, money out, and about 42% of borrowing households, so that's more than 1.5 million Australian households, are already finding the cash flow issues today a problem, and that's before any rate rises.
Wow. Based on your assessments, what proportion of mortgage holders are going to struggle then to repay their loans if interest rates go up, which is even at 0.4%, which is the upper range of what's been forecast?
So if we see rates go up by, let's say, a couple of percent over the next year or so, that could mean more than 400 to 500,000 additional Australians will find those cash flow pressures coming in. Now, it doesn't mean they're all going to fall over tomorrow, right? And you're right, there are others who have huge buffers, but a lot of these households have very little buffers. They have a lot of debt, their incomes are under pressure, their costs of living are rising, and so this is going to put a lot more pressure on a lot more households.
Banks say most borrowers can still afford the loan even if interest rates go up by 2%, but does that factor in other costs like rising inflation?
No, it doesn't. So what's happened is that we have an underwriting set of standards from the banks that are probably okay, but they don't really get into the detail of household finances. We know that a lot of pressures on households have been there for a long, long time, even before COVID, by the way. Childcare costs, rates, fuel, wherever you look, prices are going up, costs are going up. So a lot of households obviously want to get that mortgage and will position themselves as best they can to get the mortgage. The bank, of course, uses underwriting standards that are a little bit weak. I think that this is now rubber hitting the road time for not just the last few months, but the last 10 years of poor policy and poor lending. And unfortunately, households are caught in the crossfire.
Banks also stress that stress test mortgage applicants for cost of living expenses, though, right? But generally don't assess the actual living expenses of the person getting the loan. So just going to the actual process, is it a process that should be shifted and changed? Is it a faulty process?
Yeah, it's a very faulty process. Of course, ASIC tried to get it changed, and there was that court case with Westpac, and basically the bank said, we'll go on using average ratios, and the court said that's fine. But no, it's not fine. So the trouble is that many households are actually spending a lot more than those official ratios that are used would actually suggest. And whilst the argument is, well, of course, households can trim their expenses and stop spending things on expensive food and wine, for example, the truth is that most households are not in that position. They already are finding things very difficult. And by the way, of course, incomes have not grown at all. So that's the other factor that is not in there. So unfortunately, the baseline underwriting processes are leaving many households exposed. The question, of course, then is, well, who's responsible? And the government says, well, it's a caveat emptor world. Borrowers should be able to borrow as much as they want. They tried to take away the responsible lending obligations a few months ago. I do think that actually banks have a responsibility to make sure that people don't get into difficulty, because most borrowers will assume the banks are doing the work.
Tell me about so-called liar loans. How widespread are they, and how could they play into what we're about to see?
Yeah, it's a very important issue, and it's hard to know precisely, but it's quite clear to me that there are, maybe a third of loans being applied for where not everything is actually in there, or it's presented in a particular way, thanks perhaps to a mortgage broker, to make it look better than it really is. And unfortunately, liar loans don't come to the surface until things get really bad. And by the way, the thing to bear in mind is most people will do whatever they can to go on paying their mortgage, so they'll cut back on other things. They'll cut back on dental treatment or clothes for the kids or food before they actually start dealing, with not paying the mortgage. So the mortgage is the last person standing when it comes to, dealing with financial pressures. But that isn't fair on households, let alone, I think, on the broader community.
So who are those people who are most likely to find themselves in trouble when interest rates go up, and where are they located?
So some different cohorts are definitely in the cross sites at the moment. A lot of people who've bought relatively new, often in those high growth, high development estates in the regional, in close regional areas close to the major capital cities, southwestern Sydney, for example, and Narre Warren down in Melbourne will be good examples. We're also seeing some old households who may have moved, for example, up to the Central Coast in New South Wales, expecting that their mortgage would actually be relatively low, despite the fact that moving towards retirement. A lot of those are actually in difficulty. And then we've also got some more affluent households, for example, young buyers in Bondi who bought very, very expensive properties because their incomes look pretty good are suddenly finding that they've got issues. So different patchwork stories in different parts of the country, but a lot of different households actually being impacted now.
Banks and the government say a lot of households used government supports over the last 2 years to create this financial buffer for themselves. What proportion of households were able to do that? And I suppose more importantly, what proportion are struggling more now than they were pre-COVID?
Yeah, so pre-COVID, there was about 32% of households who had difficulty. Now we're at 42%, so that's another 10% move. And the government's partly right. So some households were able to build their buffers over the last while. And I agree, there are some households who are going to do fine and can handle a very significant rate rise without any issues. But I'd also make the point that initiatives like the home buyer stimulus package for first-time buyers or the home builder programs brought forward a lot of demand, brought forward a lot of people into the market who probably shouldn't have got into the market, and that was government policy. So in a way, you could argue that government policy is partly to blame for the inflationary pressures because, of course, building cost was in there as well. And it's also pulled a lot of people forward who probably have been better not to have gone into the market at the time. So in a way, you can't just blame the international context here. Policy over the last few years has been partly responsible for what's happened.
New Zealand is further down the road than Australia. Their central bank has already started lifting rates. What impacts are we seeing there?
Yes, it's a very interesting case study. 1.5% is their cash rate at the moment, and already we're seeing house prices coming off. We're seeing the proportion of new business being written dropping dramatically. And interestingly, a report came out this week to say that the Bank of Mum and Dad in New Zealand is now the fifth largest lender. We're seeing a similar thing here. So it's really created a dynamic situation where prices are falling, the volume of new sales is falling, the pressure on households over there is also rising. So in a way, I think you can play that same film here, and we're a few months behind, but unfortunately I think we're going to go the same way.
Will this result in a drop in property prices, and could that ultimately be problematic, obviously, for the people who are in that situation, but make housing perhaps potentially more affordable?
Well, there's a fundamental question here. What is a fair price for a property? We are way overpriced relative to any long-term ratios, you'd like to say, about 40% actually. And that's because of the very low interest rates, the significant availability of credit, which has driven prices high. This is a debt-driven phenomenon that we've got. We can't go on letting that happen forever. We absolutely do need to tackle the issue of high prices, and they need to come back. And, okay, that's going to destroy some people's on-paper wealth, but strategically for the country, we have to get back to more sensible prices. This, of course, has been created by the quantitative easing programs here and around the world, so this is not just an Australian situation. But this is actually really the fallout from the global financial crisis and beyond, when central banks started printing a lot of money and inflating asset prices. That has to be unwound at some point.
Martin North, thank you so much for joining us.
Good to talk to you.
Martin North is the principal with Digital Finance Analytics.